The ICF Training and Technical Assistance Team is honored to welcome you to this California Housing and Community Development Community Workshop offered through the Emergency Solutions Grant Coronavirus Relief Consulting and Staffing Services Contract. I am Chris Pitcher from ICF, and I'll be hosting today's session. Today's session is part of our new and non-traditional training series. So this workshop series today will be focusing on ESG and ESG-CV program monitoring. It is my pleasure to hand the presentation to our first presenter, Mike Thomas. Mike, please take it away.
All right, thanks, Chris. So yeah, I'm Mike Thomas. I use he, him pronouns. I am a technical assistance provider with ICF, and I will get us kicked off on our content. But first, I will let my co-presenter, Gordon, introduce himself really quickly too, for those who might not have joined us before. Gordon?
Greetings, everyone. My name is Gordon Levine. I'm also a TU provider with ICF. My pronouns are he and him, and I am white and Jewish, and very excited to be with all of you this late morning.
Yeah, thanks, everyone. So today's topic is program monitoring. So I will get us started on our content. We're going to talk about how monitoring applies to the ESG programs under California HCD. So this is our agenda for today. We're first going to talk about federal monitoring requirements. So what has to be done? We will talk about critical program areas for monitoring. So if you are going to be monitored, what program areas would you be thinking about? And then we're going to talk a little about the monitoring process. We won't get into super deep detail on that, but we're going to go in general into what a monitoring process looks like. And then for the second hour, we'll have a quick intermission. We will have our lightning round where we will do some interactive questions with you. And then we will have a time for question and answer. We do have it divided into 2 hours here, but I will note that the content might be a little bit lighter. So we might even get you out of here a little early today. So we will see. So a quick note on where the focus area is. When we think about ESG funding, it comes from HUD, so they're at the top. And then you've got the primary recipient, which is, in this case, we're talking about California HCD. This training is focused on the subrecipients below California HCD. So that's usually a local government, which is the subrecipient. And then any one that they subgrant funds to would be sub-subrecipients. So those bottom 2 tiers that you see there, that is where our focus area is with this content. And then we always like to throw up these acronyms so everyone knows what we're talking about. We might not use all of these in this training, but we still want to make sure everyone is aware of them because we live in alphabet soup when we work with federal and state programs. So this is what the common ones are. ESG is the Emergency Solutions Grant Program. ESG-CV is money that was made available through that same program through the CARES Act. So it's a special allocation of the ESG program. FY is the fiscal year. That is the year in which ESG funds are allocated by HUD. CAHCD is California Department of Housing and Community Development. They are the largest ESG recipient in the state. HUD is the U.S. Department of Housing and Urban Development. The recipient is an entity that receives ESG directly from HUD. So again, California HCD in this context. The subrecipient is a local government entity or nonprofit that receives ESG from a recipient. You may also see us say sub-subrecipient. That would be an agency that is subawarded funds under a subrecipient. So there's a couple of tiers there. And then, as I like to say, maybe the least attractive of the acronyms is UGLUG. That is a unit of general local government. And then we also like to remind everyone how regulations and policies interact when we think about ESG. So there's several layers. So the federal uniform guidance covers the vast majority of federal programs, and it determines administrative issues and financial issues around costs, how things are documented, things like that. So that sits at the top. And then you've got the ESG interim rule in this context. So that is the regulation specifically for the ESG program. And then you've got HUD guidance. So that takes the form of HUD's responses to questions to their Ask a Question desk, frequently asked questions that they might post, and notices that they might release, such as the notice for ESG CV funds. And then you have local policies. So those are things established locally. That could be state rules. It could be local rules with the local government. All of those things must be observed to be compliant with ESG funding. So the first thing I am going to talk about as we dive into the content is the federal monitoring requirements. So according to the federal government, what has to be done? So the uniform guidance from that slide I just showed, we're talking about the guidance that covers the vast majority of all federal programs. According to the uniform guidance, California HCD, as the primary recipient of ESG funds, must evaluate subrecipient risk, and they can do so based on factors such as the following: prior experience with the same or similar subawards, results of previous audits, whether the subrecipient has new personnel or new substantially changed system, or I'm sorry, new or substantially changed systems, the extent and results of federal awarding agency monitoring, and other risk factors that might be determined by HCD. So it's important to note that the uniform guidance puts these examples out there as factors that may be used to determine risk, but ultimately it's up to California HCD to determine the matrix for their risk analysis. Ultimately, the risk analysis is designed to evaluate risk of noncompliance with federal statutes, regulations, and terms and conditions of the subaward. The uniform guidance also says a few things about monitoring. According to the uniform guidance, California HCD must monitor activities of subrecipients as necessary, and that can be done on a risk-based, using a risk-based approach. And this can include ensuring that California HCD ESG or ESG CV awards are used for authorized purposes and in compliance with federal statutes, regulations, and the terms and conditions of the subaward. So in other words, we're talking about looking at the activities that are being carried out with that ESG funding and making sure that they are compliant with all of the federal statutes, the ESG regs, and the terms and conditions of the contracts under which they are subgranted. So for the subgrantees, we're talking about the standard agreement there. Reviewing any California HCD required financial and performance reports, ensure that the subrecipient takes timely and appropriate action on deficiencies pertaining to the ESG award that is detected or that might be detected through audits, on-site reviews, and written confirmation from the subrecipient, and then issue a management decision for applicable audit findings pertaining to the California HCD ESG or ESG CV award. So that's really just going through what the uniform guidance says. As we get deeper into this presentation, we are going to give you more details about what all of these things mean and what it looks like practically during the monitoring process. So don't get too confused by it at this point. We are going to get more into what this means at the practical level. There are some other requirements spelled out under the uniform guidance. Specifically, California HCD may employ the following tools and others at its discretion related to monitoring. So they can provide subrecipients with training and technical assistance on program-related matters and perform on-site reviews of the subrecipient's program operations. So what we're saying there, one thing that's really important is the monitoring process is not designed to just be an evaluation of compliance. It's also designed to be an opportunity to identify when technical assistance might be needed, and then to provide training to make sure that agencies can implement the program effectively. HCD must also verify that every subrecipient received a single audit as required by federal regulation if they receive over $750,000 in federal awards. And that can be either directly or as pass-through funding. And then they must consider whether the results of audits, on-site reviews, or other monitoring activities necessitate adjustment of HCD's own records. So in other words, is there something happening with the ESG program that requires California HCD to make adjustments to their ESG award records? And then consider taking enforcement action against non-compliant subrecipients. So that's when we start talking about, if there are egregious violations, what kind of action might be taken to remediate that. The ESG program interim rule does also say a few things about monitoring. So again, if you remember that circle around compliance we showed you, we just went through the uniform guidance. Now we're moving on to the ESG program interim rule. Administrative funding provided for the ESG program specifically covers monitoring program activities for progress and compliance with program requirements, coordinating the resolution of audit and monitoring findings, and any travel costs incurred for monitoring of subrecipients. So the fact that the ESG interim rule authorizes funding to be used for monitoring thus implies that it is something that should be done for the ESG program. HCD must also maintain documentation of all monitoring and sanctions and keep record of each recapture and distribution of recaptured funds. So if HCD monitors and they determine that funds need to be recaptured from an agency because they are misusing funds, they must keep records of how that happens and what is done with those funds after recapture. So in summary, HCD is required to monitor each program, function, or activity funded by its ESG and ESG CV award. Monitoring is not limited to a one-time event, but is rather an ongoing process that assesses the quality of ESG and ESG CV funded programs and assesses performance over the life of the award and involves continuous communication and evaluation. So while the monitoring visit is of course going to be a point in time, the overall process is continuous. The goal of the process is to assist ESG and ESG CV funded programs with improving performance, increasing capacity, and avoiding or remedying instances of non-compliance. So that goes back to what I said earlier about how it's not just designed to be a process to identify findings and concerns and penalize agencies. It is designed to be a process that helps agencies get better at implementing the program when they need help with that sort of thing. And now I'm going to turn it over to Gordon.
All right, so next we're going to talk about critical program areas for monitoring. Next slide, please. So Chapter 28 of the HUD Community Planning and Developing Monitoring Handbook establishes guidance for HUD monitoring of ESG recipients like the California Department of HCD. This is the core, this is what we would refer to colloquially as the full monitoring. It's the everything that HUD would come in and monitor a recipient about. ESG recipients like HCD can generally be expected to monitor subrecipients and sub-subrecipients for the same things that HUD would be monitoring HCD for using the CPD monitoring handbook, though those tools often look a little bit different. I've seen very few communities use the full CPD handbook as part of their ongoing monitoring processes for subrecipients. The upcoming slides are going to describe those key program areas that may be examined by HCD when monitoring their subrecipients and subsubs. Again, these areas are derived from the CPD handbook, but if you are in your head now thinking, oh, I should go look up that handbook, it's going to be exactly what will be monitored on. I would caution against that, as it's likely to look different than that. Next slide, please. So these are really our key program areas for monitoring, both in terms of what you as a subrecipient can expect, and what you as a subrecipient should be looking at for your own monitoring of sub-subrecipients. Eligibility determination and record keeping, so that's everything to do with participant eligibility and how you maintain those records. General grant management, so that's everything to do with contracting and upkeep of your grants. Sub-subrecipient grant management, so that's your monitoring of your sub-subs. Component specific items, so that's talking about what's specific to rapid rehousing, what's specific to housing problem solving is not a component, homelessness prevention, what's specific to street outreach and so on. Match requirements, it's what it says on the tin, how you deal with match and how you account for match. Procurement requirement, financial management and cost allowability. So that's everything to do with how you review and maintain records of your expenses. Procurement requirements, that's the specific relationship between your records and actions for larger purchases. made with ESG. And finally, equipment and disposition requirements. So that's what do you do once you've got your larger purchases in place. Next slide, please. So under eligibility determination and record keeping, these are kind of the key questions that one way or another, the HCD monitoring process is likely to get at. They're not necessarily going to be framed this way, but these are the questions that your responses will be attempting to answer. Does the agency, so does subrecipient, does the sub-sub, have and follow written policies for determining and documenting participant eligibility under the applicable federal definition for their ESG funded projects? We're going to come back to written standards. Or what written policies and procedures, I'm going to put a pin in that. Do the written policies establish the order of priority for obtaining evidence of homelessness? ESG recipients are required to follow the order of prioritization that is listed in the ESG interim rule, which prioritizes third party over staff observation over self-certification. You can do all of them, but you have to go through that order with each participant before you get to a lower order of priority. Does a sample of the records, and the sample could be different from recipient to recipient. It could be a random sample taken on site. It could be, please give us your 3 best files so we know what you think you're doing right. Could be anything in between. Could be a large sample, could be a small sample. Does it suggest that the subrecipient is complying with the requirements that lack of third-party documentation does not prevent access to emergency shelter, street outreach, or victim service providers? One of the little-known things about emergency shelter that is incredibly valuable, that also applies to street outreach, that also applies to DB projects, is that, first of all, the lack of third-party documentation cannot be a barrier to intake at all. It should not be even a road bump to intake into these projects. But also for emergency shelter specifically, there's an alternative standard of documentation for intake into shelter that is an even lower burden of proof or burden of documentation than standard self-certification forms. If they're using HMIS or a comparable database as evidence of homelessness status. So for example, you have a printout from HMIS that says this person was in emergency shelter last night, and we're using that as documentation. Does the HMIS system or the comparable database contain an auditable history of all entries? In other words, can you demonstrate in some way using the system that the thing that you printed off was real and not just a mock-up that you did in Adobe? Finally, did the agency maintain documentation for households determined to be ineligible for ESG assistance? In other words, if a monitor came through and said, okay, talk to me about those folks who you were referred through coordinated entry, which is a requirement, that you determined were ineligible and did not intake, where is the file on that? There should be a file somewhere. Next slide, please. I'm going to hit on written standards while thinking about it. Also, do please continue dropping questions in the chat as we go. We love to see questions. We're happy to break flow if they make sense, or we will hold on to them for later, but be asking questions. We're excited to hear them. You heard me at the beginning of that slide highlight 3 different instances of written policies and procedures. Says this, do they exist? What do they say? And did you do it? Every single one of these trainings, we are going to harp on 2 things, and one of them is written policies and procedures. Do they exist? Do they accurately describe a thing that is good? And do your actual practices follow your policies and procedures? And so if you take nothing else away from this, having high quality written policies and procedures is an essential element of program compliance, successful monitoring, and successful project implementation. Back to the slide at hand, overall grant management. Did the local government subrecipient meet all of their obligation and reimbursement timeliness requirements? So did they draw funds on time? Did they reimburse funds on time? Does the agency coordinate with the local COC, including the use of coordinated entry in HMIS as required by the ESG program interim rule? This is written in such a way as to re-emphasize that, number 1, ESG projects are absolutely positively required by federal law to use the coordinated entry system in the HMIS system, or for DV providers or legal services providers, the HMIS comparable database for their COC, which means that you have to talk to your COC, which means that you have to talk to your HMIS lead agency. And you need evidence in your participant files or elsewhere that participants are passing through these systems and are having their data maintained in those systems. Being out of compliance with that is a serious deal because they are a core element of ensuring that communities coordinate within themselves. Does the agency have written policies and procedures to protect PII, or personally identifiable information? So this is everything to do with ensuring that participant confidentiality is maintained, established, protected, and secured. Does the agency's record contain evidence of organizational or personal conflicts of interest? So this again is, do you have a conflict of interest policy? Were conflicts of interest identified? And what did you do about them when they were? Finally, does the agency comply with all other federal requirements specified in the ESG program interim rule? It's a pretty broad net. Generally speaking, what it's talking about is 2 CFR 200. There are other elements, but what they're talking about is anything else that might be listed in that section of the ESG program interim rule. That's VAWA, that's 2 CFR 200, that's a lot of stuff. Fair housing. Do you have evidence that you're complying with it in your policies and procedures? Did you actually comply with it, and can you demonstrate that in some way? Next slide, please. Subrecipient or sub-subrecipient grant management. Does the agency maintain record of all of these solicitations and awards to sub-subrecipients? In other words, can you show HCD that you have a process for selecting your sub-subs? Does the subrecipient monitor their sub-subs appropriately for compliance, including determination of risk? So do you have a process in place for monitoring your subrecipients, and does it in some way triage subrecipients by risk, so that riskier subrecipients, based on criteria that it could include but are not limited to size of grant, performance of grant, prior compliance issues, number of participants, do you triage people according to risk of the grant in terms of what would happen if it were out of compliance? Do your sub-sub awards contain all of the information required by the interim rule and the federal uniform guidance? So did you manage to pass down everything in the ESG program interim rule and 2 CFR 200? Did the sub-sub comply with the single audit requirements if applicable? So we talked about single audit earlier. Did the sub-sub comply in the event that it was relevant? Do your sub-subs meet all of the requirements of the subrecipient, HCD, and HUD? And so this is the same as self-monitoring. Do we meet all of the requirements of HCD and HUD, with the additional layer of, if the subrecipient passed down any requirements to the sub-sub, did the sub-sub follow those additional subrecipient requirements? And if this is starting to sound like we're whirling in a circle, it's helpful to think of it as like a garden fountain, or like a mountain, or like or stairs even. In that policy is layered and steps down, and everybody on the step below has to follow all of the policy set by everybody up. So it goes HUD, HCD, subrecipient, sub-subrecipient. Finally, in instances of non-compliance, which are frankly common, right? This is a complicated program. Falling out of compliance is normal as staff turnover happens, and it's a thing that happens, and it's common, not good, but it happens. Did the subrecipient take enforcement action? And enforcement action isn't, did you punish your sub-sub, but did you take action to correct the deficit? Because I feel well confident in saying that all the way up and down that ladder, all the way up and down that stair or that fountain, everybody involved, with a very few exceptions, is always about, what did you do to correct and move forward? Next slide, please. Janice, I do see that question from you in the chat. I'm going to hope Mike or Chris jump on that one about single audit. Oh, there you go. Thank you.
Oh, hi. Yeah, was I correct there? It's that it should be the requirement is when you spend more than 750,000, not just receive the
It's based on
750.
funds awarded.
Right. awarded, not spent?
Correct.
Okay.
So for those of you who don't have access to chat, the question was, it does the single audit requirement applies to organizations that receive at least $750,000 of federal dollars in a given year. The question was, is it 750 awarded or 750 spent? And in the case of single audit, it is 750 spent. Though it's a really acute and good question, because there are instances in which we're talking about money spent. Most importantly for our purposes, match. ESG match refers to money spent, not money awarded. Moving on to component-specific monitoring. These are program components or project components that refer to specific activities being carried out under ESG. So under street outreach, were all participants determined and documented to be eligible for assistance? Were all funded activities aligned with the allowable activities for street outreach in the interim rule? In other words, did you spend your money on eligible activities? Were services provided for at least the period of time for which ESG was provided? Meaning, did you provide services for the duration of the contract? And finally, were all activities carried out in compliance with the applicable ESG written standards? We're going to make a distinction here. The applicable ESG written standards refers to one and/or two documents. It refers to either or, rather, the ESG written standards established by HCD as required by the ESG program interim rule, and or whatever portion of the ESG written standards has been passed down to the subrecipient level, which many elements of the written standards can, at the recipient's discretion, be passed down. And so there's probably two documents you're referencing. Next slide, please. For emergency shelter, does the facility or project meet the definition of emergency shelter? We were talking a little bit beforehand on this call about like things that seem like they might be emergency shelter but are not, and so that you need to be paying attention to what the definition of an emergency shelter is, and does the facility qualify? Were all of the services provided only in emergency shelter or to people experiencing homelessness who are staying in emergency shelter? So that's, did you serve an eligible population? Were all of the funded activities eligible? Again, so did you spend your money on eligible activities? Does the agency have and follow a written policy for terminating assistance? There are requirements for that in the ESG program interim rule. It is very specific about what must be included. Does the agency comply with any applicable uniform relocation assistance or minimum period of use requirements? Generally speaking, that's what we're talking about, construction, rehab, and acquisition there. Does the agency ensure that families with children under 18 are not involuntarily separated? So that's if you're serving families, are you ensuring that those families are staying together? Does the project meet all local sanitation and safety requirements? That again, that goes to a local code requirement. And finally, were all activities compliant with the applicable ESG written standards? Remember, that can be set at the subrecipient level, the HCD level, or both. Next slide, please. Rapid rehousing and homelessness prevention focus areas. Chris, I see you off. Do you want to pop on?
I just wanted to, there's a question in the chat I wanted to poke at before we went into rapid rehousing and homelessness prevention. That's Jerry asked us to talk more about subrecipient standards. Do we have any more content on that?
We are going to get into the requirements for subrecipients. So right now we're just kind of going through what is typically looked at in monitoring, and a little later we're going to get into how that applies to subs and sub-subs.
Excellent. That's what I thought, but I wanted to take this a moment to note that. Okay, go ahead, Gordon.
Thank you very much. And there is another question in the chat. How do we monitor termination of services? Really, what you're going to be asking for is a list, and this is just a recommendation, but your best way to handle that is a subrecipient monitoring a sub-sub. Ask to see their list of terminated participants for the program year, and then pick one, take a sample and say, okay, show me the termination process you followed. It's easy as that. And then see if the process that was actually followed matches the process that was written down. And if it does, and if the process that's written down matches the process that's mandated by the ESG program interim rule, then they're good to go. So rapid rehousing and homelessness prevention, these are lumped together because they're very similar, even though they are serving different populations. Does the agency have and follow written policies for determining and documenting eligibility? For rapid rehousing, that's going to be, was the participant experiencing literal homelessness? For homelessness prevention, it's going to be, were they at risk, imminently at risk, or fleeing domestic violence? Did the agency reevaluate eligibility every 3 months for prevention and or at least annually for rapid rehousing? So that's a requirement. You have to continually reevaluate the participant's eligibility. Were all funded activities aligned with allowable activities? So did you spend money on eligible costs? Were the activities compliant with the applicable ESG written standards, which again, subrecipient and HCD? Did the agency connect participants to mainstream benefits as needed? So this is really about duplication of services, but also about ensuring participants are connected with the support they need to stay stably housed. Is there evidence that, that the necessary steps were taken to identify what participants need and then connect them to those mainstream benefits, which could range from sort of low-hanging fruit like SNAP and Section 8 to more specific resources like mental or physical health, etc. And finally, were all of the assisted units compliant with fair market rent, rent reasonableness, lead-based paint, and habitability standards requirements? So in other words, were the units eligible to be served according to the ESG program and our rule? Next slide, please. That's back over to you, Mike.
All right. So match requirements. So when we think about program match, the things that would typically be asked or that you would want to think about asking yourself for a monitoring, does the agency meet its contractual match requirements? So for ESG, annual ESG, there is a 100% match requirement. ESG CV does not have a match requirement, but for annual ESG, the match amount is going to be equal to the award amount. Does the agency meet that requirement? If program income is used as match, were the costs eligible and supplementary to the ESG project? The ESG program interim rule requires program income to be turned back around and used as match. Are match sources and uses properly documented? So when you think about match funding and the accounting system, how are the match sources documented and accounted for? And then how are the uses of match funds accounted for? Are cash contributions documented adequately in writing? So, not just in the accounting system, but cash contributions must be documented in writing. And then non-cash contributions, are they valued adequately? So the agency has to have policies and procedures around how non-cash contributions are valued, and that value has to be consistent with the fair market value of whatever it is that you're assigning value to. I see a question there about program income. So the most common example of program income you're really going to see with ESG is if security deposits for rapid rehousing or prevention programs come back to the agency. Although I want to make it really clear that the agency is not required to take those security deposits back to the agency. They can stay with the participant. But if the agency has a policy that they take those back, then that would be one of the most clear examples of program income. There really aren't other instances where you see program income. In years past, you would see things like shelters charging fees and things like that. But that is something that we clearly want to avoid in a housing first approach. You don't really see that very often anymore. But that's in a general sense what program income is. It is income that is coming into the program as a direct result of program activities.
If I can add 2 more cents on the topic of the security deposits, the only thing I would add is that not only is it not required, we would actually recommend against, in most cases, agencies clawing back security deposits, rapid and homelessness prevention projects clawing back security deposits for really 2 reasons. One of them is that leaving the security deposit in place is a substantial financial benefit for participants and not really a huge regain for the organization. Realistically, you're probably talking about a low percentage of your total rental assistance budget coming back to you. Number one. And number 2, at the agency level, The financial management required to track security deposits coming back in, to say nothing of actually getting them back from the participants, is extremely burdensome all around. And so leaving them in place can, at the end of the day, save you a lot of headache while significantly benefiting your participants.
Agreed. So now we're thinking about financial management and cost allowability. We kept them together here because those two things do kind of work hand in hand. For financial management, we're thinking, are financial policies, procedures, and records adequate to determine if ESG requirements are being met? So overall, when you think about your financial systems, your documentation, can you determine from all of that if the ESG requirements are being met? Do records adequately identify sources and uses of federal funds? Much like match, the federal funds have to be accounted for in the same way. You have to identify sources and uses very clearly. Do records indicate sufficient internal controls over grant funds, property, and other assets? So you have to have an effective system of internal controls to make sure that assets are being used in alignment with the appropriate regulations and other standards. Does documentation support the amounts requested for reimbursement? So if a reimbursement request is sampled during a monitoring, does the documentation to justify that request support the amount that was on that request? And then in terms of cost allowability, does a review of transactions demonstrate that all costs were eligible under the regulations, that the costs were necessary and reasonable for program operation, and that they were allocable to the program? So Gordon mentioned earlier that there are two things we're going to harp on in every training we do. He talked about the written standards. The thing I am always going to harp on is that costs must be allowable, reasonable, and allocable. And that's what is going to be reviewed in a monitoring. Are charges for salaries and wages supported by payroll records, accounting records, and timesheets as required by the federal cost principles? I put that one in here specifically because that's one of the bigger items that is typically going to be sampled for review during monitoring, staff costs. And staff costs always have to be supported by those three things: payroll records, accounting records, and timesheets. Are indirect costs charged to the ESG award supported by an appropriate indirect cost rate methodology? So if you're charging indirect costs to the award, do you clearly have it documented which methodology you're using? And then does a review of expenditures indicate the absence of unallowable costs, including any related to lobbying or political activities? So in other words, if you pull an accounting report that shows all of the costs to date for the grant that's being monitored, is anything unallowable evident in that? And then we start thinking about procurement. So for procurement, does the agency have and follow written procurement policies and procedures? Do solicitations clearly and accurately describe the technical specifications of the goods or services requested? Was a price or cost analysis performed for every procurement action? And do contracts contain all required elements by regulation? This is not going to be applicable to everyone. This is only going to be applicable if you are purchasing more expensive things that are subject to the procurement requirements. But in the event that you did, these are the things that would be asked. And then finally, equipment and disposition requirements. So for equipment, does the agency maintain equipment records that meet regulatory requirements? And then has physical equipment inventory been taken and reconciled with property records? That's an important one if you purchased equipment. So I'm just going to reiterate that. If you have purchased equipment, you have to have a process to periodically do a physical inventory of that equipment and then reconcile that with your records. So do you have the equipment that your records say that you have? And then in disposition, do the agency's policies and procedures require efforts to secure the highest possible return on the sale of equipment? And if grant-funded equipment was sold, is there evidence to demonstrate efforts to obtain the highest possible return? So that's straight out of the CPD monitoring handbook. Essentially what they're saying is you have to make some effort, you have to do due diligence to make sure you're getting the correct value for equipment should you sell it. So now we're going to get into monitoring responsibilities. This is where we'll talk a little bit about what I had mentioned earlier with that question that was in the chat. So we're going to talk about how this applies to different agencies in the stream of ESG grant funding. So this is the first thing we'll show you here. I called it the monitoring waterfall because it cascades. It has tiers, starting with HUD at the top. So HUD must monitor California HCD. Now, what I'll say is when I say HUD must monitor, it doesn't mean HUD is going to come every year. HUD does monitoring based on risk as is required by the uniform guidance. So they might not monitor HCD every year, but HUD is required to monitor recipients like HCD. HUD also may monitor subordinate agencies as necessary. So when you see that arrow at the top there that crosses all of them, that means HUD has the right to monitor any of those agencies that have received ESG funding. They're primarily going to monitor the recipient, like California HCD, but it is actually a customary thing that when they monitor the recipient, they're going to pick some subrecipients and review their records as well. And they might also do the same with subrecipients. So HUD can monitor anyone in that chain. California HCD must monitor subrecipients based on all of the things we've just talked about. So again, it's going to be risk-based, but they must monitor subrecipients and they may monitor sub-subrecipients as well. So just like HUD can go all the way down the chain, California HCD can go all the way down the chain too. They're going to monitor subrecipients, and then they are probably going to dig into records for some of the sub-subrecipients as well. Underneath HCD, you have got these subrecipient agencies. They must monitor their sub-subrecipients. And if they deliver services directly, they must also ensure self-compliance with everything that's applicable. And then sub-subrecipients don't have to monitor anyone, but they must ensure self-compliance. The only reason a sub-subrecipient would have to monitor would be if they further subgranted down the chain, but I don't think that's very common. It's important to note that that sub-subrecipient at the bottom could be monitored by any of those agencies that we just went through. So when we talk about responsibility for monitoring here, the important takeaway is, as we said at the beginning, we're going to focus on subs and sub-subs for this presentation. So subrecipients of California HCD ESG funding must have a process to evaluate risk and monitor their sub-subrecipients, and they would do so using information like we have just presented. So those are the types of questions they'd be asking. Those are the types of things they'd be looking at. And then again, sub-subrecipients must be prepared for that type of monitoring, and their primary responsibility is to maintain their own compliance. So just getting into a little more detail, HUD monitors California HCD as the primary recipient. They must monitor primary ESG recipients pursuant to 2 CFR 200, so that's the federal uniform guidance. And they perform this monitoring using Chapter 28 of the CPD Monitoring Handbook. So when we said all of those things we just talked about were adapted from that handbook, it's absolutely correct that you don't see that implemented for monitoring at the subrecipient and sub-sub level that often. It's usually some adaptation of it, but that is exactly what HUD uses when they monitor their primary recipients. And again, they reserve the right to look at any subrecipients or sub-subrecipients. So they can go all the way down that chain. California HCD monitors subrecipients. So those are the agencies and local governments that receive ESG funds from California HCD. So California HCD is the recipient. They receive the funds from HUD, and then they award those funds to local subrecipients statewide. And they must monitor them based on relative risk. They monitor for compliance with federal regulation and state requirements, and they can also look at compliance with local written standards as well. They reserve the right to examine any sub-recipients. So I'm going to keep saying it. They can go all the way down the chain to all the agencies below them with their monitoring. Subrecipients receive ESG funds from HCD via the standard agreement. They may award funds to local subrecipients. If they do so, they must monitor any subrecipients based on relative risk. They monitor for compliance with federal regulations, state requirements, and local requirements. And if they deliver services directly, they also must ensure internal compliance at their own agencies. And then finally, subrecipients. So in this scenario, they are at the very bottom of the chain. They receive ESG funds from a subrecipient via a local contract document. They do not have to monitor anyone if they are not subgranting funds further. However, they have to ensure their own internal compliance with federal regulations, state requirements, and local requirements. And I'm going to turn it back over to Gordon to talk a little about what monitoring processes typically look like.
All right. As you may have noticed, we enjoy our slide puns, and so this is indeed the gears at work. Next slide, please. So the monitoring process really looks like these 4 discrete stages. The entrance, so assuming that you've already received your monitoring letter, there's an entrance conference on the front end of the monitoring day or monitoring days or experience. The monitors will perform a review, which is usually separate from or primarily separate from staff. So they'll take materials, they'll separate themselves, they'll conduct a review. They will rejoin with staff for an exit conference, which usually involves describing any concerns or findings that may have been identified, as well as strengths of the program and talking about next steps. And finally, the monitor will issue a report in writing recapping the exit conference and putting down action items in a letter with a timeline associated with them. Next slide, please. So again, likely areas of review. Policies and procedures, can't emphasize this enough. Your written policies and procedures are the core of this experience. They're really going to be looking for program policies and procedures, but also financial policies and procedures. And especially for larger organizations, those are going to be pretty separate. And so this is, as always, a good opportunity to get your financial folks involved early so they understand what's going on. Participant eligibility, they're going to be looking at the eligibility determination, the case files that show ongoing eligibility of activities and participants, and the unit eligibility when we're talking about rapid rehousing and homelessness prevention. And finally, financial records. There will almost certainly be a sample taken of program expenses, a sample of salary expenses specifically, both because they comprise a large portion of expenses and because they're often an area of challenge. They're going to look at match records, which may be some or all, depending on what that looks like. And finally, your procurement records. So again, that's your larger purchases. Next slide, please. So for program policies and for program policy and implementation, really sort of key areas they're going to be hitting on are intake, service provision, discharge, which includes both termination and graduation, follow-up, and then coordination with mainstream and COC resources. And so really what they're looking at is the life cycle of a participant, from when you begin serving them, when you cease serving them, what you did in the middle, what you did after to make sure that they stayed housed, and how well you coordinated with folks outside your agency. From a financial perspective, monitors will be or should be looking at your internal controls around purchasing, your payment processing, and payroll processing, really, your audit requirements, and whether you met them, your fund-based accounting, your match valuation and tracking, and your procurement processes, again, your big purchases. Please do note the italics at the bottom. This list is not even slightly exhaustive. These are areas that may be examined and really will be examined, and they're areas that are likely to be looked at closely, to have a lot of attention on them, and that you're going to want to continually self-monitor for throughout the year. But the core point is that policies and procedures really should address all program requirements, and they need to tie out to actual practices. Next slide, please. For eligibility determination and record keeping, for emergency shelter and street outreach, you're really looking for emergency shelter documentation that someone is experiencing literal homelessness, and if they're fleeing domestic violence, they're fleeing domestic violence. Or for street outreach, you're really talking about at-risk eligibility determination, or literal homelessness documentation. Those street outreaches, in effect, itself documentation of literal unsheltered homelessness. You'll be looking for supporting documentation for eligibility determination, and that's the order of priority we talked about before: third-party certification, self-certification, or staff certification, self-certification, and in the event the participant was found ineligible, the reason for ineligibility, if it's applicable. And again, sort of more broadly than the ESG program interim rule, ESG projects are generally held to a standard of housing first. And so determination of ineligibility generally, either through the ESG program or through the local coordinated entry system, will generally be restricted to if there is a very strong reason that the participant could not be served by this agency. So it's not, we didn't really like this guy the last time we saw him. It's this participant is a better fit for this other program we referred him to immediately, or this participant was not eligible under the homeless definition, or this participant presents a clear and present threat of danger specifically to one of our staff I've seen in places. It's sort of only, but for the most serious cases, are reasons for ineligibility. For rapid rehousing and prevention, we're really looking at, for rapid rehousing, documentation of literal homelessness. For prevention, we're looking for documentation of at risk or imminently at risk, which are two separate definitions. Supporting documentation, again, that's getting third-party staff certification, self-certification. If they're determined to be ineligible, you need to justify that. This, incidentally, is a great place for a note to file, because if you just stick something in there that does not explain that it is the reason for ineligibility determination, a monitor is liable to miss that. And so the note to file is a powerful tool here. Unit eligibility documentation that touches on fair market rent, reasonableness, lead paint, and habitability. Note that the lead-based paint standard is nuanced, and in some cases does not apply. For example, if there are not children under a certain age, or if the unit is built after a certain year, the activities that need to be conducted around lead paint are different than if there are or are likely to be children under a certain age, or if the unit is built before a certain time period. And finally, whether a lease and rental assistance agreement is in place, and whether those documents meet all of the standards for those documents. And there are fairly specific lease standards for ESG, depending on whether it's rapid rehousing or homelessness prevention. And they include, but are not limited to, some language that is related to the Violence Against Women Act, and ensuring that leases can be broken in the event of domestic violence to allow participants to change spaces for their own safety. Again, this list is not exhaustive. Next slide, please. For financial records, for salaries, we're really going to be looking at payroll records, accounting records, and timesheets. Those are kind of the three core documents that make up any given salary expense, and they really need to have all three of them in place. Even though, for example, accounting records, it's likely to be one record for all salary expenses for the period. For equipment, you're really going to be looking for procurement records. So did you follow the relevant procurement process? Did money go out the door? So payment records. And what did you do with it? That's your disposition records. So where is the equipment now, and what was it used for? For all other expenses, really, we're looking for kind of two separate pieces. And what that looks like is going to depend on what the cost is. Generally speaking, you're looking for one document that establishes that an expense existed, right? Somebody tried to charge you something, or someone charged you something, and evidence that money went out the door for that expense and was allocated to the relevant ESG budget line. So sort of the most simple example would be for emergency shelter, under the food provision, somebody went out to your relevant grocery store and purchased food. The documentation of cost is the receipt that says food cost $20, and the payment record is the receipt that shows that a credit card was used to pay for that. And then ideally there would be a cover sheet on top of that that says this was paid for this and ties this back to ESG emergency shelter, which is this line on the general ledger. Again, this list is not exhaustive. These are kind of what generally monitors will be looking for financial records, but everything is subject to being examined. I think we're good to go.
Yeah, sorry about that. Next slide.
Yeah, please. So match, this is going to depend a little bit, but generally this is what a monitor will be looking at for match documentation. A letter of commitment or another document for cash match that establishes that the cash match was provided. For in-kind match, documentation of the valuation methodology. And finally, accounting records that document the source and the use of matching funds. And so for cash match, that really is anything that's, it ranges from an MOU from another agency or another department within your agency that says, yeah, we're providing $10,000 of match from this source for this activity, all the way up to receipts demonstrating that it was spent. The valuation methodology for in-kind match is kind of out of scope for our discussion today, but broadly, in-kind match needs to be valued in a way that is coherent with the fair market value of the thing. The example that I like to give is volunteer time is a reasonably common source of in-kind match. Volunteer time is assessed based on comparable activities performed by someone within the organization, or if there is no one within the organization, in the labor market in general. And so, for example, if an MD who's making $200 an hour volunteers serving food at an emergency shelter, those hours would be valued at the time that is coherent for a person serving food at the shelter and not for the doctor performing surgery. Next slide, please. Monitoring outcomes. So generally speaking, on every single element, I guess, on every single element or every point or every question or every angle or any piece of a project that's being monitored, there's going to be one of three responses that a monitor will provide. They will clear it, which is they'll say it's great, no violation of program regs or standard agreement requirements. So it didn't violate a contract, it doesn't violate the interim rule, it doesn't violate the uniform requirements. A concern, and a concern is a little bit nebulous. So we'll do finding first. A finding is a clear violation of program regs or standard agreement requirements. Those are generally tied back to contract language or the interim rule or another federal requirement. It is pretty clear cut, and they are generally provided with a timeline in which it needs to be corrected, as well as a specific corrective action or actions that need to be put in place. A concern is somewhere between the two. It represents a condition that, if not corrected, may result in a violation of program regulations. Different monitors handle them different ways, and different concerns can be handled in different ways. Some concerns may be basically findings and may have a timeline and a requirement to correct. Some may be, we think that this is an issue, but it's not a violation yet. So please spend some time thinking about this and consider whether you're going to take some action on it. We will revisit next year or anywhere in between. Do note that a failure to address findings is one of those areas in which we can fix this going forward, goes out the window. Once a monitor has produced a letter stating that you need to meet these requirements by this date and time, you should follow that letter. And failure to do so can amount to a breach of contract that can ultimately lead to loss of funding, loss of contract, loss of future funding, and so on and so on. Yeah, that's what I got to say on that. Next slide, please. Back over to you, Mike.
Thank you. And so now we'll talk about what happens after the monitoring. So if you have had a monitoring visit, You went through all of the things we just talked about with your monitor. This is what would happen after the fact. It's important to note here that if the monitoring report has no findings or concerns, then there's probably not any further action necessary. You'll probably just get a copy of that report and maybe even a clearance letter. The process varies from place to place, agency to agency. California HCD will have their process. And then if you are a subrecipient and you monitor sub-subrecipients, you can determine what your process is in that respect. But if there are no findings, then there might not be any more action necessary. If there were only concerns, then you would likely issue something with those concerns, and the follow-up would be based on how you handle concerns. So if findings or concerns do exist, then the process is probably going to progress through these steps, again, depending on how you've designed it locally. But generally, what you expect is that there will be a report, so a full written document that shows what happened during the monitoring, what was discovered, where the findings were identified, and where concerns were identified. Once the report is issued, then there will be a response. The agency would be expected to issue a response to the monitoring entity to that report. That response, if there were findings or concerns, should include a plan to address them. And if it's findings, there's likely going to be a requirement to include some sort of corrective action plan with a timeline to address those findings. The monitoring entity then reviews that, and then based on what they have received in response, will issue either a clearance letter or a non-compliance letter. And they may hold off on issuing either of those if there is a corrective action plan. So they may say, we agree with your corrective action plan. We are going to come back in 3 months and make sure you are implementing it before issuing a clearance. So that could be part of the process too. But after the review, at some point when the monitoring entity is either satisfied or not satisfied, they will issue a clearance letter or a non-compliance letter. There can be remedial actions, as Gordon mentioned, tied to unresolved findings from a monitoring. So these are the possible remedial actions. If an agency is determined to be in non-compliance and they are unable to resolve that, the remedial actions may include, but are not limited to, temporary withholding of reimbursements, request repayment of previous reimbursements for disallowed costs. That's a really important one. That's one that the federal government implements on its programs. They call it question costs. So if they identify question costs during a monitoring, they can request that the agency repay those costs. Subrecipients have the right to request that of sub-subrecipients if you identify things that are not allowable. And California HCD can do that with subrecipients as well. And then in extreme instances, one of the remedial actions could be suspending or terminating the grant contract in whole or in part. So if the violations are egregious and they cannot be remedied, it could result in terminating the program. So those are all possible remedial actions. Wanted to point out here some common findings and concerns from monitoring visits. So, we've gone through all these program areas that are typically looked at. These are the things that tend to be findings and concerns to some degree. So inadequate or non-existent policies and procedures. Gordon talked a lot about written policies and procedures. We do always harp on those in our trainings, and you have to have them. Those have to exist. So if you're a subrecipient under California HCD, you need policies and procedures at the subrecipient level. And then if you are a sub-subrecipient, you also need policies and procedures at your agency level. They have to exist at every level. If they're non-existent, that is an issue with monitoring. Inadequate participant eligibility documentation is a very common one that leads to findings. You have to document participant eligibility consistent with the federal regulations, plus any other requirements of California HCD or the subrecipient if you're a sub-sub. So that's a common one. You have to do that well. Failure to comply with HMIS requirements. That's another common one. You're required to enter certain data into HMIS for this program, and that has to be done consistent with federal requirements, and it has to be done consistently with the local continuum of cares requirements around HMIS. Failure to comply with that is a common finding. and or concern, depending on the severity. Inadequate financial documentation. So we talk, a lot about what's required to document match, what's required to document federal expenditures, sources and uses, all of that good stuff. You have to have backup for your financial transactions with these funds, whether it's the federal portion or the match. Doing that inadequately, that's a common finding or possibly concern, again, depending on the severity. And then inadequate procurement records. So I mentioned earlier that this isn't applicable to everyone. Not every program purchases things that are subject to procurement, but when agencies do purchase things that are subject to procurement, it is not uncommon for the records to be inadequate. So we're calling that a common one too, but common amongst a smaller subset of agencies that actually do things subject to the procurement rules. That takes us into our intermission.
All right, everyone, welcome back from break, from our little intermission. We are going to proceed to the next session here, part of our session on our lightning round questions. Mike, are you beginning us this afternoon?
Yep, I sure am. So yeah, we will get started with some interactive questions. I think we have 10 of them for you today. So let's go ahead and jump right into those. And you're going to have some polls pop up on your screen in a second to answer these questions. But here's question number 1. So which of the following items is not true of ESG monitoring under California HCD? The federal uniform guidance requires them to monitor subrecipients. Monitoring is usually a one-time event and is only repeated when projects are non-compliant. ESG administration funding can be used for activities related to monitoring, or the goal of monitoring is to assist projects with improving performance, increasing capacity, and avoiding or remedying instances of non-compliance. Which of these is not true? There's your poll. So go ahead and choose which answer you think is correct. Strong response there. Like we have almost everyone say monitoring, it's usually a one-time event, is not correct. And one person's, 3 people now said ESG admin funding. And I don't know how many people we have in here. It looks like we've got 63% have participated so far, but we have a really strong response there. So I think I'm going to go ahead and call this one. And we will move on and show you the correct answer. And in this instance, the majority of you were correct. Monitoring is not a one-time event. It's an ongoing process that assesses the quality of the program and performance over the life of the award and involves continuous communication and evaluation. So congratulations on a strong response for that one for the correct answer. You guys were paying attention. Good job.
All right, question number 2. Which of the following is most likely not a program area subject to ESG monitoring? Which of these is most likely not subject to ESG monitoring? Is it corporate office compliance with local safety codes? Is it grants management? Is it cost allowability? Or is it participant eligibility? Which of these is likely to not be monitored under ESG? Poll should be up. Oh, and the responses are pouring in. Y'all are like highly caffeinated this afternoon. Sometimes it's like molasses, but y'all are just like, bam, in there. It's about to be very Midwestern. Be like, yeah, it's like maple sugaring time. It's just coming straight out of the trees. Nobody here knows what maple sugaring it is. That's fine. Don't worry about it. We're good. One in the chat knows what the fall tradition of maple sugar harvesting is. So does Mr. Chris Pitcher, Esquire. We've got mostly responses in. We're going to call it done there. 100% of you said corporate office compliance with local safety codes, and that is of course Correct. Facilities used for direct service provision are subject to ESG regulatory standards and local safety codes for the applicable facility type, but corporate offices are usually not used this way. Good job spotting our trap. Next question, please.
Okay. So this one's got a little bit of a story aspect to it here, mostly just because I wanted to pick names from a pop culture reference. So Hector is an ESG program manager at a local subrecipient of California HCD that provides direct services. He is reviewing client files and records for an upcoming monitoring visit. Hector notices in the agency records that several people who were assessed for eligibility were referred to other resources because they were deemed ineligible for ESG. The records do not contain specific reasons for ESG ineligibility. Will this likely be a monitoring finding if Hector is unable to determine why they were deemed ineligible? So the records don't contain specific reasons. If the monitor selects those records and notices that there are not specific reasons, is that likely to be a finding? And there's your poll. It looks like we are getting another pretty quick response from the group on this one. Pretty strong on the yes option. We have a couple of people saying no. Like we have a few more people answering. See if anyone else is coming in. I was hoping we get to about 60%. But we've got an overwhelming majority, so I think I am going to go ahead and call this one. The majority said yes, and the correct answer is, of course, yes. This will likely be a monitoring finding. The program interim rule specifically requires that service providers document the reason anytime that they deem a household ineligible for ESG assistance. That documentation process should be included. Again, we're talking policies and procedures. It should be included in your written policies and procedures and applied consistently during the intake process at your organization.
Very good. Y'all are doing great. Question 4. Mike, maybe a different Mike, is the grants administrator at a different local subrecipient of California HCD ESG funds. His agency administers awards to several sub-recipients. Which of the following will likely be examined in a monitoring of Mike's agency? Which of these is likely to be examined in a monitoring of Mike's subrecipient agency? Is it communications between executives of Mike's agency and Mike's agency's sub-subs? Communications between case managers at Mike's agency and case managers at sub-subs? Policies and procedures at Mike's subrecipient agency for monitoring sub-subs? Or overall funding portfolios at sub-sub agencies? Polls up there. This question is really about, oh, y'all got it. Y'all on it. This question is really about what's likely to be assessed, what's likely to be monitored between a subrecipient and their sub-subs. So we've got answers pouring in. We're still a little shy of our high water mark as folks kind of think it through. Answers coming in. Proud of y'all.
And Gordon, there's a question in the chat as well that might be prudent to answer while we wait for responses.
Yeah, sure. So I've got a question in the chat that says, does that mean every client file funded needs a reference of why? Can you clarify a reference of why they received intake? And feel free to drop the answer in the chat. While we get to that answer, I think we can close that poll. Overwhelmingly, people say policies and procedures at Mike's agency for monitoring sub-subs. Let's have a look at the answer. That is, of course, true. Y'all are very much on it today. As pass-through agency, Mike's organization is required to monitor sub-subs for performance and compliance. Let's go ahead. So we've got a clarification in the chat. Needs a reference of why ESG was not the funding source. So I take that to mean, does that mean client files need a reference of why ESG was not the funding source?
I think
Yeah.
Do you mind if I take a stab?
Yeah, go for it. I'm still parsing it.
So if you have a variety of funding sources, if you assist a client with something that's not ESG, you don't have to put in that file why they didn't get assistance with ESG unless they were assessed for ESG and deemed ineligible. So we're talking here specifically about the ESG grant. So if someone was referred to your agency and you assess them for eligibility for the ESG program and determine that they didn't qualify for ESG, then you have to document why. But if the client was never assessed for ESG and they went straight to some other funding source, you wouldn't need any kind of record in that instance.
Yep. So that's a good parsing on that one. And so I would boil that down now that I've kind of got my arms around it. Yeah, really, you don't need to document why somebody received assistance from a source other than ESG unless they were denied for ESG, because we're assuming, in fact, that participants are benefiting from many sources, mainstream benefits, other COC programs, et cetera. Not only is that normal, it's encouraged and expected. And if you had to document all of them, your case managers would never get done typing. So let's go on to the next question. And if you have any follow-ups, just drop in the chat.
All right. So question number 5. Which of the following is true regarding monitoring of client records for all ESG project types? So when you think about, there's the 4 types, you've got your emergency shelter, street outreach, rapid rehousing and prevention. Which of these is true for monitoring client records for all of them? Only a sample of client files is subject to review. Only client files from the current contract year are subject to review. Personally identifiable information in client files may not be made available to reviewers, or all client files and records funded by the applicable ESG program are subject to monitoring review. Which of those do you think is true? Getting a pretty strong response, and we have a few guesses on each of them this time. I think that's the first time we've had that so far in this one. But the majority is saying all client files are subject to review. Got a few people saying PII. And then we've got a couple of people saying the top 2 options as well. We still have a few answers coming in. Looks like maybe we have stalled out around 66%. So we'll call that, and let's see what the correct answer is. The correct answer is that all client files and records funded by the applicable ESG program are subject to monitoring review. The funding agency, that could be California HCD, or it could be a pass-through subrecipient, but whoever the funding agency is, reserves the right to review all client files funded by any of their respective ESG awards. They also reserve the right to view personally identifiable information for these purposes. Now, they will have a policy that they use to handle personally identifiable information. So they have to follow that policy, but they can look at PII as part of the monitoring process. While client review often starts off with a sample, the scope of review may be extended when compliance issues are identified. So if they sample, say, 10% of clients and determine that pretty much all of them don't have eligibility documented appropriately, they can extend their review to look at as many client records as they would like under that funding source, because that becomes a big compliance issue very quickly. All right, next question.
All right. Which of the following is not likely to be reviewed when monitoring financial management for ESG? Which of these is not likely to be reviewed when monitoring financial management for ESG? Is it documentation of sources and uses of federal funds? Is it acquisition records for agency accounting software? Is it agency processes for internal financial controls? Is it documentation of costs and amounts related to reimbursements? Which of these is not likely to be reviewed when monitoring financial management for ESG? Okay, answers coming in hot. Just waiting for a few more. Folks are working it through. Noodling on it a little bit. That's good. Always okay to not know the answer. It looks like about everybody. There's a strong response rate. 93% said acquisition records for the agency's accounting software. Let's see the answer. That is, of course, correct. Accounting software is rarely charged to the ESG program, and when it is, it's usually through indirect costs, and as such, detailed records are very unlikely to be reviewed. Next question.
Okay, question 7. Gus is the chief financial officer for a local subrecipient of California HCD ESG funding. HUD is currently monitoring California HCD's ESG program and requests several financial records from Gus related to a reimbursement that his agency received from California HCD. So there's a couple of layers there. California HCD is being monitored by HUD. They have requested records from Gus's agency that is a subrecipient. Gus is reluctant to provide these records directly to HUD. Is he required to do so? All right, again, a strong response. We have a lot of people saying yes. We have someone saying no there too. All right, maybe a few more people want to give it a shot. Looks like we've stalled out around 59% there, so we can call that one. Most people said yes. And the correct answer to that one is, of course, yes. Gus is required to provide these records to HUD. As the primary grantor of ESG funds, HUD has the right to review all ESG funded agencies, including subrecipients and sub-subrecipients. They can go all the way down that chain that I talked about earlier. It is an expected part of monitoring to review records in this way when monitoring a pass-through agency like California HCD. So not only is it something HUD can do, it is something that they will do when they monitor HCD. They will likely look at subrecipients and possibly sub-subrecipients as well.
All right, question 8. Lydia is an intake worker at a high volume emergency shelter funded by HCD. Her shelter works mostly with a relatively transient homeless population, so she sees many different people enter the facility. The agency tracks participants with a sign-in sheet that contains self-certification of homelessness, but is rarely able to get further documentation. Would this generally be considered acceptable documentation for monitoring? So would the sign-in sheet that contains self-certification of homelessness be generally considered acceptable documentation of homelessness for monitoring under emergency shelter? Yes or no? I love this question. Thank you for giving it to me, Mike. It's my favorite.
I thought you would like that one.
Yeah, I love this one.
Also one of the trickier ones.
Yeah, this is the most divided response we've had all day.
Yeah.
It is a real Gordon question. It's absolutely true. It's policy oriented, it's eligibility oriented, it's a little tricky. Takes a nerd to answer it. It's the truth. All right, well, that looks like, oh, people are still pouring in. Folks are excited about this question. Oh, let this play out.
We must have some shelter providers on the line.
Yeah. 29 of them, at least, all of whom have strong opinions. I can hear the clicks from here as people are slamming their mice to answer this question. All right, well, let's call it. It's an 80-20 split, 80 saying yes. So let's see what the answer is. The answer is, yeah, it's almost certainly acceptable. The ESG program interim rule, this is, I touched on this earlier. The ESG program interim rule requires projects to preferentially acquire third-party documentation first, and then only after they've determined third-party cannot be established, they may move on to staff certification, and then only if neither of those can be found, move on to self-certification. However, it also requires that the lack of third-party documentation not be a barrier to accessing shelter or street outreach. The sign-in sheet is likely acceptable if the agency also follows up to obtain higher level documentation when possible. I would also add that HUD did put out an explainer around the sign-in sheet issue specifically for ESG-funded emergency shelter, which I'm going to try and track down for y'all, that specifically touches on this issue and provides backup to the yes, it is okay to use a sign-in sheet at an emergency shelter, because those 30 of you who were slamming your mice to get your answers in are all well aware that at a busy emergency shelter, stopping everybody at the door, even for a self-serve form, is just too much of a road bump for some participants. Next question.
You know, something we didn't put on here that I should also mention is there is also a slightly different standard for DV shelter providers. So, you know, with a standard shelter, this would be acceptable, and then you try to get that other documentation if possible. DV shelters are only expected to try and pursue alternate documentation beyond self-certification if that can be done without jeopardizing the safety of the person or household seeking shelter. So I think it's important to note that as well.
Yeah, and also there's a question in the chat that I want to hit while we're on it. The question is, does this, meaning this, presumably this alternative emergency shelter thing, but does this generally need to be written into agency policy for emergency shelter entrance? And so the answer is basically yes. So you should absolutely have in your project policies and procedures a description of the order of priority in which you seek documentation of homelessness, right? Third party, staff observation, participant self-certification. And if you intend to use a sign-in sheet as your primary mechanism of documenting literal homelessness as an emergency shelter, you should absolutely write that into your project policies and procedures. Absolutely no reason not to, both because HUD requires, or basically requires, that it be there, but also because if you're going to do that as practice, it should be written down somewhere. And that's really one of the core parts of your written policies and procedures, is if you're going to do something as a core element of implementing your project, you should write it down somewhere for reference. So good, really good question. Really good question. On to the next. We got another one. Is there an example of a policies and procedures in outline form? No, is the really short answer. The reality is that policies and procedures are always going to be specific to the project in question. It's a little outside our scope today to kind of talk about how best to go about that. But there are kind of two approaches to assembling policies and procedures at the project level. One of them is looking at the requirements that are laid down in the interim rule, which will touch on other federal requirements, and in your ESG written standards and in your contract, then incorporate all of those, and then also incorporate a good outline of what your actual implementation looks like. Or you can ask another project in under the same ESG grantor, if you could borrow a copy of theirs, have a look at it, and then adapt it. I personally think that the first method is a better one because it's less likely to put you in a position where you accidentally adopted a rule that you don't follow or know nothing about. But those are the two sort of general standard approaches to developing project policies and procedures. Also a good question. Back over to you, Mike.
All right, question number 9. Which of the following is not something that would be examined when reviewing match documentation during a monitoring? Which of these would not be examined? Receipts, letters of commitment, or MOUs for cash match, contact information for donors of cash match, documentation for how in-kind match is valued, accounting records showing sources and uses of match. Which of those would not be looked at during a monitoring? We continue with a very strong response up front. Looks like we've got a couple of people taking the bottom 2 options, the majority taking contact information. We've got a spread across all of the options now, but most people saying contact information. It's like we've got about 63%, 65%. That is pushing the maximum we've been getting to. 69%. Can we make it 70 before we call it? That's one of the highest response rates I've seen so far. I don't think we're going to make it to 70 though. We can go ahead and call that one.
Nope, they did it.
Oh, look at that, 71%. Good job, everyone. I appreciate you humoring me there. So let's take a look at the correct answer. The answer is contact information. Contact information for donors of cash match would not be reviewed and monitoring. The main elements of documentation for cash and in-kind match are those that establish that the cash or item was received, those that establish the value of it, which is very simple with cash because it's money, but with in-kind, you have to establish value in other ways. And then those that show how the cash or item was used in a manner that is consistent with the ESG regulation, because to be eligible as match, it has to be used for things that are eligible under the ESG program. What is going on there?
Try clicking, I bet it's hidden behind the answer. There you go.
Yeah, there we go.
Yep.
Okay.
So if an ESG recipient, subrecipient, or sub-subrecipient is deemed to be out of compliance during monitoring and then subsequently fails to resolve monitoring findings in a timely manner, which of the following is not a possible remedial action? Is it reporting the agency to the IRS for tax implications? Is it temporary withholding of reimbursements? Is it requesting repayment of previous reimbursement for costs that are disallowed, that are no longer eligible? Or is it canceling the grant contract? Which of these is not a possible remedial action? The poll is now live. While you're doing that, I'm going to go ahead and drop in that FAQ to the chat box around emergency shelters using sign-in sheets or alternative third-party documentation. This is an official HUD FAQ, ID 1843. I found it invaluable. It is very useful. Answers are coming in. I think we can, folks are still getting it in. All right, cool. Yeah, this is very interesting. All right, I think that's everybody. So most people are saying reporting the agency to the IRS. You're of course correct, as you have all been all day. Reporting the agency to the IRS is not a remedial action related to ESG monitoring. ESG monitors are not really tax experts, generally speaking, and this is not really the scope of the ESG monitoring. But everything else on the list is absolutely a potential consequence of failing to follow up on remedial action. I would also highlight that nearly 20% of you said cancellation of the grant contract is not a possible remedial action. I would highlight that that is not correct. Being out of compliance and maintaining yourself out of compliance in the face of specific corrective action can absolutely result in a contract being canceled.
And I think that
that's it.
wraps us up.
That's it. We're into Q&A. We're into dedicated Q&A.
Yep. I'm going to take
All
this.
right. Thank you, Mike. Appreciate that. So as like Ward said, we are into our official question and answer section. So today's topic is project monitoring, program monitoring, excuse me. I have 2 questions loaded, but do note that you can put questions in the chat. You can raise your hand. We will unmute you. You can ask your question verbally. You can just unmute yourself and ask us in a very dialogue-driven way, whatever is easiest for you. But I do have 2 to start with. One is from Jennifer, and this talks specifically about some of our ESGCV waivers. So this might combine a couple of different things. There might actually be a couple answers to this. So I wanted to just prime that for Mike and Gordon before I ask the question. If ESG rapid rehousing program utilized the COVID waivers to pay rent above FMR to rent reasonableness, as instructed by HCD, and a rapid rehousing recipient, a client, is still eligible when the next funding round is awarded, and that recipient, that client still needs help, how does the program deal with the fact that the rent is above FMR and no longer applies to rent reasonableness because the waivers are no longer available? What do we do with that client? This is a real life real sticky thing that's happening in many of our communities. And I see Gordon going to take a first shot at it.
Yeah, I'm going to take for shot at it. So this is not the first time we've heard this question in California or elsewhere, because it's a very real problem and it's a very ongoing problem. As you all know, ESGCV, well, HUD in response or in concert with ESGCV offered a variety of waivers during the COVID-19 pandemic, or during, I should say, the early stages or the ongoing stages of the COVID-19 pandemic, not to pretend that it is over now, it certainly is not. Waivers were in effect, and one of the waivers allowed units to be rented above fair market rent as long as it still met rent reasonableness standards. And so the question fundamentally goes to, okay, we've still got this participant, they're still eligible for services, we still want to give them services. The waiver has expired since the last time we renewed them. Can we keep serving them? What do we do about this unit that we've been renting over fair market rent? So there's kind of two answers here. There's the regulatory answer, and then there's the humanistic answer. The regulatory answer is that FMR is recertified for, this is rapid rehousing, right? Yeah, so this is rapid rehousing. Fair market rent is recertified on an annual basis or more frequently thereafter if the lease amount changes basically by any amount. And so assuming that the lease amount isn't being changed by the landlord who very much wants to get less money, we're talking about annual recertification for the participant. And so until the participant is recertified in accordance with the annual recertification requirement, or if for some reason the project recertifies more frequently, which I think is unlikely, but in the event that they're recertified more frequently or at the annual recert, that's when the new FMR kicks in, and that's when the unit needs to meet fair market rent standards. If the participant is 6 months into a 12-month lease that was originally certified under rent reasonableness but not FMR, they're good for the next 6 months of that lease. There's absolutely no problem there. It is only when the lease is reassessed or when the participant's eligibility is reassessed that FMR and rent reasonableness are reassessed. And that's the point at which you have to revert back to using FMR as the cap, which puts you in a bind. Because now you've got a participant who's in a unit for $1,000 and FMR is $900. And you're going to go to the landlord and say, HUD said we have to pay you $100 less a month. And the landlord is going to say, okay, well, I said I need to get a new tenant. And so that's when having a strong landlord-tenant relationship, having a strong you and landlord relationship is important. And so forecasting that ahead of time, preparing the landlord to know what's coming down the pike, letting them know that there is going to be a change, explaining why that change is out of your control, and ultimately talking through the benefits of retaining a participant, even if the rent is a little bit lower, are all really going to be in your interest. Back when I was a service provider, the most effective argument that I ever made with a landlord, and the one that I saw win the day most frequently, was, look, here's the deal. You can absolutely get another tenant in and you can make an extra $100 a month. But with us, most of your rent is guaranteed. And if there's a problem, you have somebody you can call who will absolutely always answer the phone. And so you might be getting a little bit less money, maybe, you don't know, but you will definitely have less of a headache. And having those conversations with the landlord about the secondary benefits of having an ESG participant in a unit that goes beyond just the base rent amount is a really effective strategy for engaging that. Mike, anything to add there?
I don't think I have anything to add. I think it's an interesting question because now we have the extension on ESGCV. So people like agencies using ESGCV don't have to worry as much about it at this point as they thought they had to a few weeks ago. That being said, if you were using annual ESG funds that were being used for COVID response, and you were planning to transfer the person over to FY21 annual ESG funds, there could be some considerations there because the same waivers aren't going to apply to those FY21 funds. So you'd have to be careful with that. So it really, there's a little bit of situational specifics there. So it kind of depends on what you're trying to do, but I agree with you, Gordon. I think everything you said is accurate.
That was the way I read this question, because they said ESG using COVID waivers. So I believe this was an annual ESG, and they talked about a second application, which would also say annual ESG. So I think that is the situation that Jennifer was specifically talking about. Jennifer, I see you in the chat saying you would like to ask a follow-up question. Since we're on your question, why don't you come off mute and ask that question?
And I would add, Enrica, I see your question there that is pertinent to this also, and we'll grab that after Jennifer's.
Yep.
I wondered if, I know with some programs, and I don't know if I believe it's not true for ESG, but let me just double check. If we're in this particular situation and the landlord isn't being kind, and El Dorado County is huge hit by the Caldor fire with the loss of affordable units, can ESG pay the rent up to the fair market value and ask the participant to pay the extra, let's say $100?
That is not allowable under the ESG regs.
Okay, all right, thank you.
Unfortunately, there's no situation in which, so this is usually referred to as a side deal. Participants can't have side deals with landlords to pay the gap between the rent and affordability. And the reasoning behind that is ultimately that they're probably already paying 30% of their income or similar toward rent. And so any more than that would make them severely rent burdened. I see. Sorry,
we got a few questions. I've got them all lined up here, Gordon. So I'm going to go back to a question early on in the session from Eleanor that I did not answer, but I wanted to talk about, and it's about program income. So I cannot remember which one of you was talking about program income, but that is what it's going to be about. So if we have a sub that receives a return of a security deposit, which is considered program income, what would be the eligible uses of that program income? What are the sub's responsibilities and eligible uses of a security deposit returned after the grant has ended? It's a little two-parter.
Oh, that's a good one. So in terms of eligible uses, you have to roll the program income back into the project, and you have to use it for eligible activities for you have to use it as though it was ESG, right? It comes back to you, it's program income, but it's still ESG funds, basically. Incidentally, program income realized in this way is included as match, and so it is part of your matching requirement, which is a little lanyap, as we would say in Louisiana, for your match requirement. The question about what you do with with a security deposit, if it comes back to you after the program year, is interesting. I would say, and I would love Mike's kind of second opinion on this one. I would say that it's still obligated to be spent as ESG on ESG within that ongoing contractual stream.
And what I would add is, HCD's contracts are for 2 years, and they are ultimately responsible for the ESG funds. So just because the subrecipient's contract ended does not necessarily mean that the ESG contract at HCD's level has ended. So if it's returned after the fact at the subrecipient level, it's probably still within the contract period of HCD, most likely. So there is also an argument that it would need to be returned to HCD. I honestly think that this is a compelling reason not to claw back the security deposits, because you eliminate this entire problem.
And Mike, there's a clarification from Eleanor in the chat, which I think is going to further complicate things. This isn't ESG money. This is ESG CV. So theoretically, ESG CV is ended. There is no next year. It is a one-time stimulus funding. So this would be the same thing that happened about a decade ago with the Homeless Prevention and Rapid Rehousing Program, also known as HPRP. And I would say, specifically to Eleanor and ESG CV funds, don't take those funds back. Let the client have those funds, because there is no mechanism for us to be able to reuse them after ESG CV ends. The program is over. So if it's after September of 2023, I would not ask for those funds back. And you are correct. There are no matching requirements for ESG-CV. But annual ESG versus ESG-CV is very different, because one's an ongoing program, one has a definitive end date.
If I can just add to that, everything Chris said is absolutely correct. But in the event that you happen to get a security deposit returned for some reason after the program is over, you've now passed outside the realm of we can give you a coherent answer. The HUD AAQ is there for you.
That's right.
That's
That was all theoretical.
yeah, you're absolutely there.
All right, we have a question from Rachel. What if your rapid rehousing participant has a voucher that has a higher payment standard than fair market rent? I think we might need Rachel to come off mute and ask the rest of that question, because I feel like we're missing something there. Rachel, are you able to ask us that question directly?
Hi. So currently we have a rapid rehousing program that is funded through ESG-CV, and the entirety of our participant list received emergency housing vouchers. In Sonoma County, we just raised our payment standard to 120%. There are next to no units at FMR, and the monetary gap between that is like $400 to $500 between FMR and what is actually considered rent reasonable out here. So my concern was we are only going to be providing the security deposits in that case so that there's no DOB. But I was wondering if those units would still have to meet the FMR standard, or if they don't have to.
All right, so let me try this one, because this is a great question. I love this. So clarify for me. The situation is that you've got a list of participants who are going to receive ESG-CV for security deposits and EHVs for ongoing assistance. Do I have that right?
Yes.
Okay, then that's the right answer. In that situation, from an ESG perspective, you're in good shape, because ESG-CV does not use fair market rent, it uses rent reasonableness. And so if you can establish that rent reasonableness is consonant with the higher level that's permissible under EHVs, then you're fine. The thing that I would caution is that when a participant is served by ESG, even if it's you provide 1 day of case management, even if it's you give them one security deposit, they're still fully bound by the rules of that program. And the same applies to EHVs. And so you got to make sure that whatever the payment standard is meets the needs of both of those programs. But it sounds to me like you are in good shape since you're using ESG-CV. If you were using annual ESG, you would be kind of up a creek, because the entire thing would now be bound by fair market rent as the cap.
Okay, thank you. That's kind of what I figured, but I just wanted to make sure I established for sure that I had correct thinking in that manner.
Yep, I think you're in good
Thank you.
shape. Absolutely, and I do think that that's a good, for what it's worth, that's a good marriage of funds. Thumbs up, good thinking.
Thanks, Rachel. All right, our last question for the day from Erica. Can we continue to pay rent at the unit over fair market rent until the client can find an eligible unit? And this was building off our earlier question.
All right, well, I think that was mine, so we'll round it out. Unless, Mike, you have a deep desire to fall on that one?
Whichever.
Right. Nah. Okay, so the question is, can we continue to pay rent at the unit over FMR until the client can find an eligible unit? It depends where they are on the recertification process. If we go back to our earlier hypothetical example, you have a client who's in a 1-year lease, and they were certified over FMR 6 months ago, and their lease is not due for renewal, and they're not due for recert for another 6 months. Yeah, you can continue paying over FMR for the remainder of that contract, the remaining 6 months of that contract. That's no problem at all. The question is called when the lease turns over or when the participant is recertified. However, if the situation is that you are now at recertification, so that participant's done all 12 months, you're now at the recertification process, you recertify, you discover the unit is over FMR, can you continue paying FMR until they can move somewhere else? The answer is unfortunately no. You cannot ever, for annual ESG, without a waiver in effect, you cannot pay for rental assistance, which enfolds direct assistance, arrears, security deposit, and the rest of it. You can't pay any of that on a unit that does not meet both fair market rent and rent reasonableness values. And it's a hard line in the sand, unfortunately.
Thanks, Gordon. Mike, anything to add, or shall we just wrap up?
I think we're good.
All right, then thank you, Mike, and thank you, Gordon, for that. And thank all of you for joining us today. Thanks for attending this California Housing and Community Development Community Workshop session offered through the Emergency Solutions Grant Coronavirus Relief Consulting and Staffing Services Contract. Look out for more information on our next new and non-traditional providers workshop series session, which will be next month on rapid rehousing. So please join us for that. Until then, have a good rest of your week.
Thanks, everybody.